All right, folks, welcome to Investing for Beginners podcast. Today, we're going to have a fun show. Today, we're going to continue our breakdown of the pivot framework. Last week, we did P and I for portfolio management and idea generation. Today, we're going to talk about valuation, which is probably our favorite topic. And what we're going to do today is we're going to break it down into three different parts. You're going to get a beginner resource, you're going to get an intermediate resource, and an expert resource. And stay till the end, because even though some of this may be a little bit over your head, we're going to show you how the School of Investing can help you put these tools to use and help you become a better investor. So that's a little secret that I probably shouldn't have shared quite up front, but what the heck, we're all friends here. So let's dive in and talk about the PE ratio. So what are your thoughts on the PE ratio?
Yeah, PE ratio, definitely the most discussed valuation metric when people say, I have no idea how much this stock should be priced at. The PE is one that's a good shortcut to use. And the easiest way I know, it's not like you can just throw a PE at it and it'll say, okay, we're throwing a PE and the stock's worth $125. It's more so people use it to compare to other companies or to compare to the average. So it's like if the S&P 500, aka the stock market, has a average PE of 18 and my stock has a PE of 20, maybe it's a little tiny bit expensive. That's kind of how people start to use PE, and it's actually a pretty decent way to shorthand kind of shortcut your valuation.
Yeah, exactly. So can you break down, like, how do you calculate a PE ratio for those that are like, what are they talking about?
Yeah, 100%. So PE stands for price divided by earnings. You're taking the stock price and you're dividing the company's earnings. Another term for earnings is net income. It's just their profits.
Yeah.
So you got to go apples to apples. When we look at a stock chart, if it tells me that Microsoft's trading at $400 a share, that's a per share. So we don't want to compare that to the tens of billions that they make in profits. We have to go per share and per share. So when you divide price, the stock price, which is a per share, by the earnings, you also need the per share. So you go stock price divided by earnings per share, gives you a number. And that can range anywhere from 10 to 40, but it can be as wide as, it's unlimited. Thousands, it could go negative. But in general, you'll see that kind of range of 10 to 40. And it changes over time, depending on what year you're talking about, all these factors. But yeah, that's kind of the gist or the big picture of it.
Yeah, that's a great breakdown. The way I like to think about it is it's an easy ratio to determine what people are willing to pay for a dollar of earnings. If you think of a PE of 20, for example, that really means that it's 20 to 1. That's kind of the ratio. And so if you are buying a company that's trading at a PE of 20, you are willing to buy a dollar of earnings for that company for $20. And the higher the number, obviously, the higher you're willing to pay for it. So if a company is trading at a 75 PE, then you're paying $75 for $1 of earnings. And that's where you start to get into this whole discussion of what's expensive and what's not expensive. Another caveat that you probably need to throw out there when you're thinking about the PE ratios is Andrew mentioned the apples to apples. You cannot compare the PE ratio of Ally Bank to Amazon or Microsoft or Google. It's not a fair comparison. They're not in the same industry. They're not in the same sector. And generally, certain industries and companies will have lower PE ratios than others just because. It's not a hard and fast rule. Like, you can't go to a bank. There's plenty of banks and insurance companies. We were actually talking about an insurance company last night. Kinsale is trading at, 35, 38 PE, and then other competitors are 10 or 12. So it's not always an apples to apples idea when you're comparing sectors, but it is a good relative way to determine if you're trying to figure out what bank is more expensive than another, then that PE ratio could be a good kind of place to kind of start to wrap your arms around that idea.
Yeah, super good caveat. And if you haven't master that idea, make sure you master it, because like you're saying, it can, if you don't think that way, you can misapply the PE
Mhm.
ratio quite poorly, and that will not be good for your portfolio.
No,
So
not at all.
could you give us like the good, the bad, the ugly of PE ratios? Like, what is a good PE ratio? How would investors decide those kinds of things?
Right. Well, if we're going to talk about the good, bad, and the ugly, I think there's some things you probably need to, I guess, kind of understand about the ratio. So the first part of it, the good part, is it is an easy way for investors to discuss other companies with each other and relate whether a company is expensive or cheap, and vice versa. And it also translates really well to comparing industries across kind of the markets, so you can kind of see maybe these markets are these sectors are a little more expensive than others, and so it's a really good relative tool to help. And the ranges, like you said earlier, it's gonna be all over the map. As a general rule, I guess I like to look for companies that are trading 20, 25 or less as a PE, and give you kind of a sense of, okay, are these generally expensive or not? Once you start getting above there, then you start playing other games when you're trying to value companies. And so I think it's easier, especially when you're starting, to look for things that are under that range. So something under 25, I think, is probably a decent place to start hunting for ideas. You can, they can go negative, and like Andrew said, they can go really high. So it's something to be kind of aware of. But again, it will differ a little bit by sector. Retail is going to be different than banks, and banks are going to be different than e-commerce, and e-commerce is going to be different than cloud or SaaS or semiconductors. So there can be some variations in that, but as a general rule, I like to look at 25 or less. What about you?
I guess for me, I'm probably playing in the 20 to 35 range, and I've maybe dipped above 35 one or two times, but not necessarily proud of that.
Mhm.
That was a quite the exception to the rule, right?
Right,
No,
exactly.
I like your idea, especially if you're starting out. There's
Hmm.
so much power in having a filter that
Hmm.
can just say, you know what, I'm gonna cut my universe, and so I have less options, especially when you're starting, um, because there's too many options. Like, it's overwhelming if
Right.
you
It
you
it
don't
can be
start that
very overwhelming.
early.
You will see this every once in a while on social media, where people will discuss, hey, if you limit yourself to a PE ratio of under 25, you're going to miss this company, or you're going to miss this company. And yeah, that may be true, but kind of, I always try to come back to this idea that Buffett always espoused, that we don't have to swing at every pitch, and you can have fantastic returns without investing in, pick company B. It doesn't matter. You can still do great without picking every single awesome winner. And it's more about building your portfolio as opposed to worrying about this particular company or that particular company. Because like Andrew said, there's so many options that you gotta learn what works best for you, and try to stick to that.
Yeah, very, very well said.
Yeah. So, kind of moving through the bad and the ugly, and these kind of overlap. So the bad part and the ugly part really come down to the PE ratio is not perfect. There are imperfections in any ratio, and the PE ratio is not immune to any of these. Uh, if a company is not generating earnings, it's going to be negative, and we generally try to avoid companies that are losing money, and that's just kind of a hard fast rule for us. And you can go into that path, but that's a different kind of investing, and I guess we try to steer clear of that. And so that's something to kind of keep in mind. And then the ugly part of it is when there are earnings, is probably the income statement. The earnings are probably the places that you see the most manipulations by management/accounting teams in industry. And so whenever there's fraud, generally it stems from the income statement, because all these statements feed each other. And so when they do some sort of bad thing on the income statement, misstating revenue, or accounting for earnings that didn't really happen, there's lots of different ways, the shenanigans, the financial shenanigans, if you will, that they can manipulate the numbers. The other thing to keep in mind too is not everything on the income statement is tied to the core business of the company. So I'll give you a quick example. Amazon owns Rivian, and as a part owner of Rivian, they own, I don't know, 15% of the company or something like that. When Rivian reports their earnings, good or bad, that gets reported on Amazon's income statement. And so that could either positively or negatively boost the earnings of Amazon. And that has nothing to do with the operations of the business. And so that can skew the numbers funny without Amazon having any impact on that at all. And so if you try to just look at the income statement, not knowing that, you could think, oh, what terrible. And Berkshire Hathaway falls into the same category for a different reason, because Buffett has this huge investment portfolio. The way the accounting rules work now, they have to account for the fluctuations in the values of those companies that are in that portfolio on their income statement. So if the market is having a terrible year, then they're going to be, air quote, losing a lot of money, which has nothing to do with the operations of the business, and that's what we're trying to value. So there's just things like that you really have to be cognizant of when you're trying to value a company, and basing it on the earnings, and the PE ratio directly ties to all of that.
Yeah, that's all super key. And if I can just add one more, you mentioned retailers and home builders. My love affair with home builders, they also fall into this, but very cyclical industries, these where you'll see huge swings and earnings go up and down depending on if the economy is healthy or if it's in a bad shape. That can really make the PE ratios go nuts. And a lot of those, you'll tend to see PE ratios that are really low, like below 10 or 7 or 8. That can be pretty common. So don't get overly excited when you see, your mall retailer down the street trading at a 6 PE. It's because the market knows that those earnings are not, it's not like Visa or MasterCard where, earnings go up and to the right in a pretty consistent fashion. These fashionable companies, these super cyclical companies, they will have these huge swings. And so just because earnings is high in 1 year doesn't mean that that's how much they will earn over a 10-year period. So you have to be very careful that that huge earnings swing can make that PE low, because as the E goes high, the PE goes low. Also, the market knows that things are priced on a long-term basis. And so they know that, again, the earnings will be fluctuating. And so that's why they won't look at the trailing earnings in the same way they look at a different company. So it's like two reinforcing factors that play into that super, super low PE.
Yeah. Those are good additions to. I think these are all things that we need to consider when we're thinking about the PE ratio. All right, so let's move on to the intermediate discussion today. So that's going to be talking about a DCF, or a discounted cash flow model. Would you like to explain the DCF to our fair listeners?
I would, and I will borrow Buffett's learning idea because I like it a lot. It's basically the idea that a bird in the bush is worth, a bird in the hand is worth 2 in a bush, right? So basically the idea is when you buy a stock, not only are you choosing to buy that stock, but you're choosing not to buy the 2 other stocks that are in the bush. And you have to always keep that in mind. If you're trying to do this like seriously or professionally, or however you want to show, like, I'm a sophisticated investor, that's kind of what you do. You're comparing yourself like, oh, well, if I just bought an S&P 500 index, like, could I have just done that? And that would have been a better option than whatever fashionable retailer down the street stock I bought and lost 40% on. If you're trying to kind of look at your investments in that way, where you're looking at your options, then that's what a DCF, or a discounted cash flow model, helps you try to do. Because not only are we looking, PE is looking at, all right, what is the company's profits today? The discounted cash flow is more forward looking. How much cash flow do I think this business will generate in the next 10 years? And then how valuable are those cash flows? they could grow cash flows, and that sounds great because my stock went up. But if my stock goes up 50%, but the market's up 400%, maybe I'm not too happy about that. So the discounted cash flow has some complicated math. At the end of the day, you don't need that many inputs. But the complicated math basically is trying to get you to think about the future cash flow of the business while also thinking of what are the alternatives you could have done with your cash to give you an ultimate value that actually that the PE doesn't do, but the DCF can do in theory, is to say, okay, that stock is worth $130 because of what the model came back with. But there's also good, bad, and ugly with that too. So I'll stop there. Like, how do you look at the DCF? Like, how do you try to teach it, or how do you apply it in your own investing?
Yeah, I'm a big fan of DCFs, mostly because it allows me to create a organized, somewhat structured system to try to value companies on a consistent basis. One of the hard parts of when you're trying to determine the value of a company is there's lots of information coming at you from a lot of different ways. And sometimes it's hard to decipher or determine what you think is important and what isn't important. And a DCF, if you are using that model to value a company like a Starbucks, then it can be super helpful because you have a structure that you're using and repeating. And so you can compare the results of a DCF for Starbucks to the results of a DCF for Dunkin' Donuts. And it can give you an apples to apples comparison, which is really hard to do in valuing a company. And a lot of people kind of, are, I guess, they don't like DCFs, and they're not perfect. And they're only as good as the inputs that we put in them. And they have the same biases that everything else has with investing. But the thing that I like about them is it allows me a structure that I can use to try to value just about any company. They have to be at a certain place in their life cycle, if you will, before they're effective. Like if you're trying to use a DCF on a brand new IPO, let's say that DoorDash went public 2 months ago, and you're trying to use a DCF to value that, it's probably not going to work out so great for you. But if you're valuing a company like a Starbucks or a Visa or just about any more air quote mature company, it's the perfect tool. And like Andrew said, it does involve some complicated algebra, but you can build models like we have that can do all that fancy math for you. And then all you have to worry about is the inputs. And I think the biggest thing that I like about a DCF is it forces you to think about the inputs that you're putting in, and it makes you understand the business. You can't just slap numbers in there and go, oh, okay, hey, I got a valuation. No, it's not how it works. And I mean, you can do that, but you might be disappointed with the results that you get from your investing. And I've been using DCFs for a while, and it's really helped my returns, and it's helped me find good investments and stay away from ones that would not have been good for me. Even if they've had good returns, just the volatility or the things that I couldn't deal with are just better. I could sleep better at night without having to worry about those kinds of things. So that's what I like about DCFs, and that's how I try to use them.
Yeah, I agree with all of that. And it also helps me in all of those ways too.
Mm.
So you mentioned the inputs.
Mhm.
Do we want to break those down kind of simply?
Yeah, I think you and I use different kinds of models, and so some of the inputs are a little different, but there's some that are not different. And like one is the revenue growth. So determining a revenue growth number for the company it's arguably the biggest driver of value in the business. And so trying to air quote get that right is a big one. And if you miss on that big time, then you could really throw off the value of the company. And so, I mean, I have different ways that I like to go about doing that, but that's the main focus for me, is trying to figure that out. What about you?
Yeah, I definitely look at the revenue growth. Like you said, can't remember who wrote on it, but they found that, what was it, like 3/4 or something of a
Mm,
company's long-term growth, talking about like their profits growth or their cash flow growth,
mm,
comes from that revenue growth. So it does make up the biggest portion. So it should, in theory, make up a bigger part of your time when you're trying to make these estimates.
Mm-hmm.
So I definitely spend time on that, but I also try to think about what are other factors that could help juice the growth, like buybacks. I like to include that. And then obviously you have the discount rate, which
Mm-hmm.
is important. And then you have to have a number for free cash flow. Because remember, the DCF looks over 10 years of free cash flow. So you have to have a starting point, and then you
Mm-hmm.
add the growth rate, and then all of those cash flows are discounted at the discount rate, and then you come up with your value.
Mm-hmm. Yep, exactly. The bottom line is when you're using a DCF, whether you use one like I use, which is free cash flow to the firm, or Andrew's, which is free cash flow to equity, you really have to determine the growth rate and you have to determine the profitability to get to the free cash flows. And once you kind of get there, then you have to figure out a discount rate. And then the rest of it is, depending on which model you use, you have to calculate for some sort of reinvestment. And those are really the four most important, I guess you will, inputs. You can get super complicated if you want. And I've seen models with, upwards of hundreds of different inputs. I guess I like our favorite Professor Demoteran's style of just having 5 or 6 different inputs and worrying about the rest of it, because the more complicated you make these models, the more your bias is going to creep in. And I think the simpler you can keep them, the easier and the more effective they're going to be.
The market doesn't care how many tabs are on your spreadsheet.
Not at all. Not at all. Not even a little bit. I guess the last caveat that I'll throw out there about DCFs is please don't get bogged down in the minutia of, okay, I think that Google will grow revenues at 12.42%. And if it goes above that, then it's going to be overvalued. Or if they only generate 10.27%, that's just not good enough. It's better, we've repeated this phrase, but I'm going to paraphrase it. It's better to be it's better to be approximately right than precisely wrong. And don't get so bogged down in the minutia of like, okay, I will only buy Google if it's 108.42. If it's above that, forget it, I'm out. No, don't try to find a range. Try to find what's approximate, what you think is appropriate, and understand that there could be there's bias in it, and it's projecting the future. Nothing except the price in a value in a DCF, or if you're using a reverse DCF, nothing about a DCF is exact. It's all guess. And so you have to realize that when you're going into using them.
Yeah, 100%.
All right. So we kind of alluded to the expert level discussion today. So we were talking about discount rates. So what are your thoughts on discount rates, and do you think is the easiest, maybe not easiest, but the best way to determine what a discount rate would be?
So 2 types of discount rates for the 2 types of DCF models. Again, you have the free cash flow to the equity, and that's the one that I use looking at the cash flow statement. The discount rate you use for that is the cost of equity. Don't ask me why. You can go read a textbook if you want to know why. If you're doing a free cash flow to the firm, which looks at the balance sheet, the income statement, the reinvestments, the ROIC, that is done with a discount rate of the WACC, because your weighted average cost of capital, because it looks at the cost of capital for the firm. So that's for stockholders and for bondholders, rather than just the equity. And because part of the free cash flow of the firm looks at enterprise value, which means you're basically looking at it like if Dave and I had our own baby Berkshire and we went to go buy the lemonade stand down the street, if we had to buy that lemonade stand and they had like $10,000 in debt, we would have to pay off the debt, but we'd also get whatever cash they had in their balance sheet and all of those things, yada, yada. So that is part of the enterprise value. And that's why you look at the debt and the equity versus if we were a baby Berkshire and we were buying shares in Apple, us or another business is not likely to buy Apple and like have to pay off their debt and all of these things. And so you're really only looking at that decision in the lens of, do I buy Apple or do I buy Microsoft or do I buy just the S&P 500? So you're just looking at opportunity costs in that case. And so that's why the discount rate for that's a cost of equity.
Mm-hmm. Yep. Great explanation. And do you want to maybe touch on like why we use a discount rate? Because we kind of alluded to that in the DCF, and maybe we can explain now that people kind of understand what we're talking about, like why we use a discount rate.
Yeah, it's quite hairy. One of the ways that I like to think about it, and it's not all encompassing, it's just one lens, okay? And I'd be curious your lens too, but I like to look at it in that kind of like a risk reward standpoint. So if I was to buy, use DoorDash, right? If I was to buy it, okay, maybe that's a bad example, but if I was to buy a stock that was a lot more risky, where kind of earnings are up and down, or maybe it's a visionary founder like a Tesla or something, the what's happened in the past might not be representative of what's going to happen in the future. And so if I bought a whole portfolio of just like a bunch of companies that were just like Tesla, my portfolio would probably go nuts. Like there'd be some huge winners and some huge losers. And so my DCFs would just be all over the map. They would be incredibly inaccurate. But what you try to do is the kind of the more risky or the more unpredictable company's future cash flows is, the higher the discount rate that you're creating, and that lowers the intrinsic value, or the value of the stock that the DCF spits out, and that just gives you like a margin of safety. So again, to use Tesla as an example, if I'm doing a higher discount rate on Tesla's DCF, I'm basically admitting the fact that I think their 10-year cash flows will be this, but it's really a much bigger guess than if I were to pick something more stable. And so I need a bigger margin of safety. And that's kind of how I think about it.
Yeah, that's a great way to think about it. And I think I probably think about it the same way, but I maybe come at it from a different way or a different angle. Like when I look at trying to value a company using a DCF, it makes the most logical sense to me to use something like a WACC because it accounts for the actual capital allocation of the business itself and the risk associated with investing in that business. And there are people out there, and I guess I disagree with this idea, but there are a lot of people out there that just use a flat rate irregardless of what company they're investing in, 10%, 12%, 15%, whatever. And that's their hurdle rate. And if they can't get a 15% return, they're not going to invest in a particular company. And I guess to me, when you do that, you're not accounting for interest rates at all. And you're also not accounting for any sort of, extenuating risk. You mentioned Tesla. It's obviously a fantastic company, but it's volatile. And you can't say with certainty this is what the cash flows are going to be in 10 years. Whereas maybe with Johnson & Johnson and Visa, you probably have a higher probability of guessing that these are going to be the cash flows in 10 years. And so, but treating all three of those situations the same, I think is not the most optimal way to go when you're trying to invest. And using something like a WACC or weighted average cost of capital allows you to account for not only the risk that's involved in the company, but also the capital allocation decisions, whether they use more debt or more equity to raise money to try to grow, because that's really what the WACC is measuring, is the cost of investments and the cost of investing in that company. And when you look at the formula, it can look overwhelming and scary, but it's really not. And once you start to dive into and understand how it works, it can reveal a lot of different things about the company. And generally, the more efficient the business is, and the more they can generate revenues from their own internal mechanisms, i.e., cash flow or free cash flow, generally the lower their discount rates are going to be, because they don't need to borrow money or they don't need to go out and sell equity on the market to generate cash to grow. And so again, all this kind of ties into the operations, the the management, all those different aspects of the business. The WACC, or the weighted average cost of capital, kind of, to me, tries to encompass all those as best it can. Is it perfect? No. Again, there is no perfect metric. Maybe ROIC is probably the closest, but WACC is not. It's not perfect, and it's still a guess. But to me, it's a more educated guess than just coming up with just a random number that you want to throw out there. And I guess that's kind of how I try to look at it.
Going back to what you said earlier about having to put in these inputs makes you think deeper than just looking at a stock chart and being like, oh, I think this. When you have to put in a discount rate, you are forcing yourself to think about, is this as stable as some other businesses in my portfolio or some other businesses that I could buy out there? And yeah, I mean, I think it's very powerful to get you thinking that way, because it can be very easy to get excited about, oh my goodness, it looks like such a margin of safety here. Did you account for the discount rate?
Right. Yeah, exactly. I mean, using your example of Tesla, if you look at the discount rates for a Tesla versus a GM, you can't have a 10% rate for either one, because one is riskier. It's a higher it's a higher growth, but it's also riskier, where the other one has a lower growth, but it also has risk involved in that you won't get as good a return. So just assigning a blank number, a flat number to every single company you invest in, I think is a mistake. And because it doesn't account, you're not accounting for some of these, biases that can creep in, or what we think about a business. And it also opens you up much more to drinking the Kool-Aid. Because if you just assign a flat rate and you come across a company that you think is the greatest thing ever, and you're not accounting for some of those potential risks, then yeah, you could do great, but you could also not do great. And the likelihood of not doing great is probably higher than doing great. And that's part of investing, is figuring out, like we were talking about earlier, the odds, figuring out the odds, and, may the odds ever be in your favor, whether you can get it right or not. And that, to me, is too hard of a game. I'd rather play the air quote number game and use that to my benefit and be consistent about it. And I think you'll turn out, you'll get where you want to go if you do something like that.
Yeah, definitely over the long term.
Mm-hmm.
I don't know if this is a good comparison, but like if you're building a baseball team and you just use batting average only, and you said, I'm only going to use batting average to evaluate every single player in my lineup. Like, you can do that. You're going to end up with a lineup of the same player over and over and over again. What's a good baseball lineup? You have some power hitters who can really hit it big, but maybe they're injury prone. Or, you got some old guys and some young guys, and you got speed, and you've got, contact, and all of these things, right? And so you would evaluate each player a little bit differently depending on what you're trying to get, what role they're supposed to play in your portfolio. And I wonder if that's something that's not thought about a lot. Like, all this focus on what's the discount rate for this one company, but it's like, actually, if you were to buy a portfolio of these, using the discount rate effectively, and like you said, applying it to different situations, helps you build and get that apples to apples, so you don't have, like, I don't know, 20 home builders or something in your portfolio and think, oh, okay, why are my results so crazy?
Right. Yeah. I think the example of a baseball team is a perfect analogy, and we kind of just saw that in the playoffs. So for those of you who are not baseball fans, the Dodgers had a great lineup, but they also played really good defense. So it wasn't like they had all these great hitters, and when they went out in the field, it's like, okay, we got to score 20 runs because we can only win 20-19. They had a really good defense. And one of the things that happened to the Yankees, who they were playing, they also had 2 or 3 really good hitters, and the rest of them were me. But their defense wasn't as good. And that's, in the end, that's what ended up defeating them, is the Dodgers had a better all-around team than the Yankees did, and that's why they won. And I think when you think about investments, to your point, you can't have 15 fintechs like I would gravitate towards, because that's just too many eggs in one basket. And if you're floating around with the discount rates too, you're going to also not get the optimal types of companies. It's okay to have this one or this one, but if you just try to follow a blanket formula to have all the same kinds of hitters, if you will, you're going to end up with probably not as optimal a result.
Yeah, it would definitely be interesting.
Mm-hmm.
So maybe this stuff's exciting, right? Maybe somebody can pick up on some of this valuation ideas and they want to take it further. Maybe they want to be able to master it and use it for their own investing. Can you tell us about the School of Investing and how we are trying to empower investors to be able to learn those concepts for themselves?
Yeah, absolutely. So what we're doing with the School of Investing is we're creating a resource where people can go and learn all these concepts that we're talking about actually in the wild. So as Andrew creates his picks every month, we're taking those write-ups and we're extracting different information from them and creating additional resources so you can learn what is a PE ratio and how does that actually apply to Google? And how can you take that information and apply it to other companies? And we do the same thing with we did the same thing with Starbucks. We showed an example of how to use a DCF and how you can translate that to not only Starbucks but to other companies that you want to invest. And we just spent a few minutes talking about a discount rate. With Casey's, we talk about the WACC, or weighted average cost of capital. And it's not just that we talk about them, we show you resources, whether it's a graphic, whether it's a podcast we've done, or it's a blog post or any other resource that we've created. We use those resources to help compare what you're reading when you read about Casey's, for example, and then think about, okay, I don't really quite understand this, but now I do, and now I can take that and apply that to other stock picks. So it's not only giving you investment ideas, but it's also teaching you how to build investment ideas. And ultimately, that's what we all want to do, is become better investors. And the School of Investing is a resource that we're creating for you to become a better investor.
Yeah, it was such a good idea that the team came up with, and
Mm-hmm.
you really couldn't have a better guy than yourself, Dave, to head that up. You and Brett, you guys are gonna be awesome. So, what I like about it personally is I feel like you can get that education. There's different places where you could try to get that, but like you're saying, tying it to real world situations where if I make a mistake, I'm losing money on these stock picks. So that there's a lot of thought in the valuation for Casey's or for Starbucks. And so by being able to use that on companies like that where there's high stakes, I think that helps with like getting those nuances and like the Starbucks having the DCF there and being able to learn by comparing the DCF and having those numbers there. I think is going to be such a game changer for people to be able to empower themselves and do all the things that they want to do and learn and grow as investors.
Yeah, exactly. And then the whole reason behind this, I mean, you and I started doing this 7-8 years ago. It's been a long journey, and we've learned a lot. And we created this pivot framework that we've been discussing over the last few episodes to try to help explain in a simple way how people can start to learn how to invest. The questions that we get the most are, where do I start? How do I start? Once I start, where do I go? All those kinds of ideas are kind of all wrapped up into this idea of pivot, and it breaks it down into a simple way that you can start to create a framework that you can use to analyze companies. And like Andrew said, this is all part of Value Spotlight. It's also all part of what he's doing when he writes up particular companies, whether it's Casey's, whether it's Builders First, Costco, Starbucks, Visa, my favorite, Microsoft, and on and on. These are all things that you can learn from in the wild. And I personally learn best from real life situations. It's not a textbook. And when we go out there and learn from a textbook and then we have to go put it into practice, it's a lot harder. So by observing things in the wild, it makes it more real, and it also puts it into context that you can translate to other things. And I think that's really, really important.
That's awesome. All right. Well, I'm going to count us out then.
Okay.
3, 2, 1. Thank you for listening and supporting the show. We appreciate all of your questions and feedback. Take action today. Connect, learn, and grow with Value Spotlight. Peace.